Warren Buffett's 13F filing is in and has disclosed a massive 25.9 million share stake in CHUBB, the world's largest public traded property and casualty insurer. A world leader in the insurance space will be going over Berkshire Hathaway's new purchase and examine how much of a percentage it now takes up of Warren Buffett's portfolio itself. We'll be diving into CHUBB itself in terms of business outlook, how they make money, and what makes this an attractive prospect for Mr. Warren Buffett. I'll cruise through their financials, giving a health check on the company itself, discuss its free cash flows and growth rate of its dividend. Before discussing its valuation at the moment and whether this is an undervalued stock that we should be looking to add to our portfolios, or a stock that has had a good run up in the market and is maybe now looking overvalued. As always, if you like this sort of content and want to see more just like it, then feel free to subscribe to the channel to catch future videos each and every week. So from the F13 filing, we can see that Berkshire's top buys and sells in Q1 included a £6.7 billion CHUBB stake. So they've put £6.7 billion in this new company. So we can see they bought 25.9 million shares that have been disclosed as being purchased by Berkshire Hathaway. And that accounts for a little over 6% of total ownership in the company as a whole. This now takes up about 2% of Mr. Warren Buffett's entire portfolio that is currently valued around $347 billion. And it now currently makes up his 9th largest holding of the portfolio itself. So this new holding is actually very in line with Warren Buffett's circle of competence as an insurance company, which is an industry and space that Warren and by extension Berkshire Hathaway feel very comfortable in from previous interviews and open sessions. So his estimated average share price is sitting at about $240, and with the news the share price has already skyrocketed well to above that now. So now we know how much CHUBB actually makes of Warren Buffett's portfolio and Berkshire Hathaway as a whole. Let's take a look at CHUBB in general, how it actually makes money and what sort of company it actually is. So CHUBB is obviously an insurance provider and they therefore provide insurance. What that might look like is that basically they offer what they call premiums, which is effectively just insurance policies to both individuals and companies as a whole. Now, that can be broken down in terms of geography as well, and they have broke that down in their Q1 earnings report. And we can see their global reach extends to 54 countries and territories. Now, we do see that 48% of that income stream comes from companies outside of the US, and we can break that down a bit more using this chart. So this is for the full year of 2023 gross premiums written as a whole, which is the majority of their revenue. Now, we do see that North America has premiums sitting at about $37 billion, and they have about 16,600 employees in that region. So that makes up 52% of their entire premiums written. Now, that's followed by 19% in Asia, with $9.1 billion in premiums from that in 2023. They have a similar number of employees to North America, and they actually have more offices as a whole because the region's probably a lot more stretched out in terms of geography. Then we have 17% in Europe, Middle East and Africa, so that accounts for $7.7 billion in premiums, and they have a lot less employees and offices. Then we've got Latin America, $3.7 billion in terms of premiums, and they have more offices and more employees than Europe, Middle East and Africa. Then we have a 5% stretch in Bermuda and Canada as well. So 48% comes from outside the US and 52% comes from within the US and North America as a whole. So further breaking down the insurance policies as a whole, and see they actually insure both individuals and companies as a whole. Now we do see that the middle markets and small commercial property and casualty insurance policies make up about 26% of their net premiums written in Q1 2024. So that actually can mean companies anything from 10 million up to 1 billion in terms of size. So that's quite a wide range. Then we have global accident, health and life insurance as their 20% of premiums. So that's just offering like personal accident, supplement health and travel accident insurance to providers. Then we've got large corporate commercial property and casualty insurance. That's 19% of the overall net premiums written in 2024 for Q1. And they have what they call personal lines making up 19%. So that's traditional high value sort of cars, homes, mobile phones, sort of liability insurance and boats and stuff like that. And then they've got wholesale specialty commercial property and casualty insurance. So that's wholesalers in general. And 2% and 3% making up smaller weightings in this overall net premiums written. So 2% towards agriculture, so crop insurance and farms. And then we've got global, what they call global reinsurance, which is effectively like catastrophe insurance as a whole. In summary, they are a business that makes money from offering premiums or insurance plans, over half of which are purchased in North America, the second highest of which is being in Asia. 48% of the premiums are also outside of North America, and 26% of these premiums in Q1 came from middle market companies, so companies that earn between 10 million up to 1 billion in revenue. This is followed by nearly 20% in 3 other types of premiums, including large corporate companies, life/health insurance and travel insurance, and more traditional premiums like insurance on homes, cars and mobile phones. It's also worth noting they also manage a fixed investment portfolio which manages $117 billion or so in a diversified portfolio that aims to maintain their cash position. So now that we've actually taken a look at how they make money, let's see how they've performed financially. If we look at their top line revenue, we can see that they've grown consistently over the past 10 years, and there's been very few dips, if ever. So over the last 3 years, they've grown 10% per year over year. So that revenue's been growing up to now what it sits at in March 2024 of 51.6 billion. And over the 5 years, we can see that's grown at a rate of about 9% and 10% for the 10-year CAGR. So very consistent top line growth. Looking at their net income, a bit of a similar story, if a few more dips. We can see that they have a current outstanding net income in March 2024 of 9.3 billion in net income, and that's actually dipped a couple of times over the past years. Obviously, we had the years of COVID, and they did a market recovery before dropping off a little bit in 2023 and coming back stronger in 2024. Their cash position has also looks like it's been increasing over that space of time, sitting now at 2.6 billion at the end of 2023. It hasn't actually got it on the graph for 2024 yet. And we can see that that's grown at a rate of about 3 years, CAGR of about 14%. So it's good to see they're growing their cash position and equivalents. Long-term debt, meanwhile, has been relatively flat and now trending down. So it increased a little bit over the past years to 2020 and now has started to come down from 15.5 billion in 2021 down to 13.3 billion long-term debt in end of 2023, which is nice to see that they're paying back their debt. And just a noteworthy thing for them as a whole, their common shares outstanding are being repurchased and brought down by the company, which is returning value to shareholders. So we can see back in 2016, they had a value sitting at about common shares 466 million, and now they're sitting at about 405 million in outstanding shares. So that's returning shareholder value to us in general. So there's quite a few positive things about this company in terms of financials. Now there's no real bad points to point out from that as a whole. They have a very solid balance sheet. So let's actually take a look at the dividend safety and growth. So looking at the start and dividend yield on CHUBB, we can see that it sits at 1.36%, which is actually very low, maybe for other dividend payers. And we've got a 5-year average that sits well above that. So it could be that the share price is increasing in value and lowering this dividend yield starting yield. The dividend safety is sitting at 99, so rated very safe, which is very good. And the dividend growth rate we will take a look at a bit shortly. The market cap is sitting at $103 billion, so makes it a mega cap company. And the payout ratio for that dividend, which is not on here, which is sitting at 17% payout ratio, which basically means they could increase this dividend considerably in the future if they so chose. So just a bit more on that dividend growth. We can see that the latest increase was 5.8% in February 2024, but over the last 5 years they've only increased it at a rate of about 3% per year. So that's not perfect. It would likely, we would want it to be above inflation at 4.2% or above. So that's not the best thing to see, because we want to see it growing in the double digits maybe, and that's what I would maybe be looking for in a company as a whole. But it is increasing and has done better over the last 20 years. So we could see this dividend growth rate increase, especially with that payout ratio we're currently seeing at about 17%. Additionally to that, their operating margins, which seems to be increasing as well. They have recommend above 15% for this company, but in general I would say that from 2020 onto the last trading 12 months, we can see that we've gone from 11% up to 20%. So that's actually quite nice to see, and I would like to see that trend increasing above the 20% range. Another thing I like about this company is its sales growth seems to be increasing in terms of margins. We can see back in 2019 it was sitting at 5% growth, and now we're sitting at 17% growth in the trading 12 months. So that seems to be increasing quite nicely. So all told, so far the business outlook is simple, predictable, and has delivered during a massive health crisis like COVID. The financials are very impressive and growing rapidly, not to mention they pay a solid dividend, even if I wish it was growing a little bit faster. But is this a company trading at a valuation that we should be interested in? I think its valuation is a lot better than some of the big tech stocks in the market at the moment, with its current price to earnings ratio, and seems to be fair when compared to some of its peers to price to earnings ratio as well. However, with the run-up in share price that we're likely to see now Buffett has bought this one, I could see that changing quite rapidly. And Morningstar has a fair value rating on it, sitting at about $236, which I think is a bit unfair and will probably change soon. In general, I think companies and analysts generally raise their ratings depending on what share prices actually do, so I don't always rely on them. But if you're interested to know, analysts sort of expect them to sit between the $260 to $280 range, and this could actually change in the coming weeks/months. In terms of me, I'm not looking to add CHUBB, mainly because I think some of the free cash flow growth in my other companies is quicker, and I understand them a lot more in my opinion. But it seems to be a good fit for Warren Buffett and Berkshire Hathaway, so fair play to them. What do you guys think of this stock? Let me know down below, and catch you guys in the next one.